Hi guys, very good morning. This is Rajesh again from RD Education Services. And so far, we have discussed what is Treasury Management System, role of a Treasury Department in corporate, objective of Treasury Management System, then goal of Treasury Management System, and function of Treasury Department. How the structure of Treasury Management, then hybrid structure. In this series presentation, I'm going to discuss about Treasury Technology. So let's start about Treasury Technology. Treasury Technology is an enabler automating daily treasury function, can help business to reach the unlimited goal of maximizing the sources and uses of funds. Automatic basic function and using a treasury management provider who can help to manage banking relationship and keep track of everything from the cash visibility and liquidity to optimize and risk management, can finally allow treasurers to ensure they are involved in the establishment of an effective treasury structure right from the very beginning. The quest for the perfect treasury structure is a balancing act of evaluating objectives, financial flows, people, technology, and corporate vision. Through a careful analysis of these factors, along with the selection of the proper underlying technologies, corporate treasurers will succeed in finding the optimal treasury structure, which quite possibly may be a hybrid combining best possible centralized and decentralized strategies. Now I'm going to discuss about function of Treasury Department. The function of Treasury Department includes, it's basically general mission of the Treasury Department is to manage the liquidity of a business. This means all the current and projected cash inflow and outflow must be monitored to ensure that there is a sufficient cash to fund company operation, as well as to ensure that excess cash is properly invested. While accomplishing the mission, the treasurer must engage in considerable prudence to ensure that existing assets are safeguarded through the use of safe forms of the investment and hedging activities. Detail of treasury. Now I'm going to discuss in detail the treasury function. In order to accomplish its mission, the Treasury Department engage in the following activity, which includes your cash forecasting, working capital management, cash concentration, then investment, grant, credit, fundraising, risk management, credit rating agency relations, the bank relations, IT systems, and last but not the least, reporting. Now I'm going to discuss each aspect in more detail. Let's start with cash forecasting. The compile information from around the company to create ongoing cash forecast. This information may come from the accounting records, the budget, capital budget, board minutes, and even the CEO. Working capital monitoring. It includes reviewing of the corporate policy related to working capital and model their impact on the cash flow. For example, looser credit results in a larger investment in account receivable, which consumes cash. Then cash concentration. Create a system for funneling cash into centralized investment account from which cash can be most effectively investment. This may involve the use of notional pooling or cash sweeps. Investments. Use the corporate investment policy for allocating excess cash to various types of investment depending on their rates of return and how quickly they can be converted into cash. Then grant credit. Issue credit to customers, which involve the management of policy under which credit terms are guaranteed. Fundraising. Determine which and when additional cash is needed and raise funds through the acquisition of debt, sale of stock, or changes in the company policy that impact the amount of working capital required to run the business. Now let's focus on risk management. Use various hedging and netting strategy to reduce risk related to changes in asset value, interest rate and foreign currency holdings. Credit rating agency relations. Keep any credit rating agency informed of the company's financial results and conditions. If these agencies are providing rating on the company's marketable debt issuance. Now let's discuss about banking relationship. Keep company bankers appraised of the company's financial condition and projections, as well as any forthcoming changes in its need for the borrowed funds. The discussion may be extended to the various services provided by the banks to company, such as lock boxes, fire transfers, and so forth. IT systems. The department maintains Treasury workstation that provide it with information about cash holdings, projections, market conditions, and other information. Reporting. The treasurer provides the senior management team with reports concerning market conditions, funding issues, returns on the investment, cash related risk, and similar topics. Now let's discuss about merger and acquisition. Basically Treasury Department may advise on the company's acquisition activity and may be called upon to integrate the treasury functions of entity being merged. In essence, treasury functions revolve around the monitoring of the cash, the use of cash, and ability to raise more cash. All other tasks of the department support these functions. Now I'm going to touch new section, that is liquidity management. What is liquidity management? Basically, liquidity management in treasury is a cash forecast. And when I'm talking about cash forecast, it's generally made over 3 time horizons, which includes your short-term cash forecast, medium-term cash forecast, and long-term cash forecast. Now I'm going to discuss first about short-term cash forecast. Generally, this covers up approximately 30 days. Short-term forecasts are usually used exclusively by the Treasury Department to manage liquidity on a day-to-day basis. Their purpose is to add decisions on the management of short-term borrowings and deposits to ensure that there are no idle balance sitting in the bank accounts and that shortages are detected and financed in the most cost-effective manner. Short-term cash forecasts are generally prepared on daily basis for the following 5 to 10 days. Opening cleared cash balance at banks are calculated and adjusted for anticipated daily cash receipts and cash payments. This day-by-day cash forecast is ideally updated on a daily basis. The following day are often prepared on a week-by-week basis, since your trends as opposed to daily movements are more important. Short-term forecasts are usually prepared by the Treasury Department from the records at their disposal or information supplied by other parts of the business. Preparation of short-term cash forecast. It is normally the responsibility of cash manager to prepare short-term cash forecast. The opening balance will be cleared balance reported through the company's bank balance reporting system. It will represent the total of cleared balances at start of the day of the banking pool or the net of the different individual account with a particular bank. The bank balance reported system will also inform the company of those payment or receipts that are being cleared through the clearing system that day, and for which the account will be debited or credited by the end of day. Now let's discuss about medium-term forecast. Medium-term cash forecast is generally prepared for financial management purposes by the various finance department within the organization. Equity analysts are putting more and more emphasis on cash flow as an indicator of the financial health of the company. Company directors also are seeing cash control as one of the primary tools in the creation of value. As a result, the management of the cash affected through the whole series of control over very aspects of working capital and capital expenditure becomes a key management issue. Central to these control is the efficient and effective forecast of the cash over the budget or current financial services and beyond. Most companies will produce medium-term cash forecast on a month by month basis, which are the updated at regular interval. Many will produce medium-term cash forecasts that cover a rolling 12 to 18 months. Such rolling forecasts ensure that control of the cash does not just go for financial year to financial years, but that a consistent control is taken over the 12-month cycle. Medium-term cash forecast usually prepared on a receipts and payment basis, which emphasis being placed on a key drivers in the cash management. Used by Treasury of the medium-term forecast. Medium-term cash forecasts are used by the Treasury Department on a number of the purposes, such as management of the headroom within the medium-term banking facility and forecasting the their observations of the key financial convent with the borrowing instruments. Treasury also used medium-term forecasts to strategize to manage the short-term liquidity. For instance, a Treasury Department with some cash surplus, if it believes interest rate may decline more rapidly that the market predicts, may use the medium-term cash forecast in determining whether to deposit those funds for a more extended period than usual. Manage the actual interest cost, which for any Treasury Department is one of their annual objectives. The medium-term forecast adds the management of derivatives and liquidity instrument to meet their objective. Now let's discuss about long-term cash forecast. Long-term cash forecast generally cover a period of 3 to 5 years time and are produced during the strategic planning process. These cash forecasts are only indicative of the likely trend of the company's cash generation. Long-term cash forecasts are little used in the management of liquidity but have a greater significance in the management of the company's debt structure. Aspects of the cash forecasting. Most companies accept the need for accurate cash forecast, but few are able to produce them on a consistent basis. One of the main reasons for this is difficult of forecasting the timing of certain major items of cash expenditure and receipts. For example, a company may have a plan the purchase of certain item of the capital equipments, but identifying the exact timing of the payment for the plant may be extremely difficult. If the assets are being specifically manufactured, timing of the payment depends on the delivery of the order by the company, the design and production at the supplier, and then delivery, testing and acceptance by the company. Alternatively, expenditures may be related to development of freehold premises, with all problems of planning, consistent and construction progress. Working capital is in some companies can fluctuate quite substantially, while companies can forecast the total cash outflow or inflow for the year as a whole. It is extremely difficult to achieve the same accuracy on a month-on-month basis. There are, however, number of general principles that have applied can lead to more efficient cash forecast. And when I'm talking about cash forecast, it is very much required to put a question to yourself whether these are full variance produced of the actual cash flow against that budgeted or more recently forecast. This analysis should give an understanding as to permanent variances and those that are due to timing. What lessons for forecasting can be learned from these variants? Then second question comes whether these are the forecasts being prepared in sufficient detail to enable meaningful variance analysis to be undertaken. Is there a continual review of the underlying assumption used in the preparation of forecast? Who vets and review these assumptions? That is very, very important and very critical. Is Sensitive analysis used to determine the possible monitoring or boundary of the cash inflow and outflow. Is the sensitivity analysis sensible and related to the historic volatility of the business? Who prepares the forecast and for what purposes? Sometimes medium-term cash forecasts are prepared for treasury by the finance function. If the finance function has no involvement in managing actual cash flow to that but updated to that budgeted, then it is unlikely that will be give the exercise high priority, may not be too concerned with its accuracy. Although time horizons used in the forecast appropriate, this is very depends on the volatility of the cash cycle of the business. It is again very critical. How frequently are forecast actual cash flow and variance analysis reports are prepared? It is again very must for a treasury department to keep an eye on the forecast and actual cash flow. The more regularly they are undertaken, they generally the more accurate they become. Specific forecast techniques should be applied to each component of the cash forecast. For example, to forecast the timings of the cash receipts from customer trade payments require an understanding of the payment methods used by the customers. That includes your checks, bill of exchange, etc. The company payment terms and billing cycle and the payment routines on their receivables ledger used by the customers. It may be required analysis of the comparative importance of different customers and different payment terms attracted to different groups of the customers. Again, question comes: do other related items need to forecast? This may include your foreign exchange receipt and payment data related to forecast to overseas sales. Are incentives aligned to management of the cash against that budgeted and forecast? And does a cash management culture pervade the whole organization? It need to be remembered that successful cash forecast is often heavily reliant on the individual preparing the forecast and their experience, skill and knowledge of the business and its current operations. In coming session, I'm going to discuss about banking relation, why any banking relationship is important for any organization, and then I'm going to discuss about, I'm going to put some highlight on credit management as well, then treasury policy on investments. Till then, thank you so much for listening.